markets have an ugly, ugly middle of the week as semiconductors plummet, driving a wash across the S&P 500, across the NASDAQ. But we are not done. Lots and lots of conversation around what could have precipitated the bloodletting today, and many, many theories circulating. But not really a clear catalyst one way or another that seems consistent with the price action, at least across most major assets. Nevertheless, we now refocus on something that is a bit more straightforward, and perhaps that will give us a bit of relief, or perhaps it will compound what is becoming an increasingly challenging story all around the world. This is Ilya Spivak, head of global macro here at tastylive. And today we are going to have a look at the upcoming monetary policy announcement from the European Central Bank. Here, the focus, not surprisingly, a little bit more clear cut than the bloodletting that we've just seen over the past session. A clear macro catalyst with relatively digestible lead-in information to suggest where it might go and what its implications might be. But of course, coming in the context of what we are watching across markets more broadly, something with a story to tell and a lesson to offer, not just for Eurozone markets and not just for the euro itself, but in a much broader way for Wall Street, for stocks in general, and for the many macro and broad asset classes as a whole. So what we're going to do here is we're going to set the stage a little bit with first what is expected, how it might register, what the impact could be, and the lesson to be had therein is where we ought to arrive at the end of that discussion. The ECB is not expected to change rates this go-round. Of course, they began their rate cut cycle last month, taking the target deposit rate down by 25 basis points from 4% to 3.75. That's the downshift you see right here. From this point forward, we see that the markets are pricing in a further 47 basis points in easing, which would amount to the overwhelming likelihood for 2 more rate cuts this year. 47 basis points is, of course, just 3 basis points shy of the 50 that you would need to fully bake in another 2 cuts. Now, if we look at the timeline here, we can see, of course, nothing is on the menu for this month. No cut implied here, although the trajectory clearly is still pointing lower and cuts are what is on the menu. We're almost there in September, almost to 3.5. In fact, the probability that we get this next cut in September now stands at a relatively commanding 76%. That cut is fully baked in by the time we get to October. And then when we get to December, we're just 3 basis points shy of that second cut. So 3.28 rather than 3.25. Now, what's interesting here is that the pathway for rates has barely changed from the last policy meeting on June the 6th. That's this dotted line hiding behind the current line for today's price action. And That's interesting because, of course, the actual economic backdrop has become quite a bit different. What we see here is that since the ECB met, which was here, the beginning of June, economic data outcomes out of the euro area have significantly deteriorated relative to expectations. Not only are we now looking at an extension of the trend from, let's call it, mid-March or so, of economic data outcomes from the euro area becoming weaker relative to baseline expectations, we've actually now pushed through the zero line on this surprise index. So that doesn't just mean that the data is now converging on expectations, which would be this right here, or starting to outperform those expectations by a narrowing margin. Rather, at this point, we are now underperforming and tending to undershoot baseline forecasts, which is to say, on any given piece of economic data coming from the Eurozone, this suggests that the tendency now is to disappoint. Perhaps no release better summarizes this than what we just saw out of the June set of Eurozone PMI data, where we unexpectedly got the slowest pace of growth in 3 months. The expectation actually was that we would remain near these highs here, but unexpectedly, we saw a faster contraction in the manufacturing sector. Perhaps no big shock there. It was expected to remain in contraction territory, though the markets were not betting on that contraction accelerating. As ever, this is in the logic of PMIs. So 50 here is the neutral line, neither growth nor contraction, and above 50 is growth. Below 50 is shrinking. The faster you go above 50, or the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so manufacturing here clearly has been in contraction to various degrees for quite some time, going all the way back to the second half of 2022. So that's perhaps not the biggest shocker in this story. Rather, it's that the service sector has suddenly started to look much more anemic after a spirited rebound in the first half of the year. We can, of course, see that last year, late 2023, we are well below 50 on all of these metrics, which lines up with a shallow recession in the third and fourth quarter of 2023 in the Eurozone. We can see since then, there's been something of a catch-up in economic growth. The latest data would seem to suggest that that catch-up has run into a wall, and this performance suggests further weakening is seemingly on the horizon. Now, while of course that's a troubling sort of conclusion, it is something that ought to help the ECB continue to push inflation in its desired direction. The latest numbers that we got had CPI down to 2.5%. That's near the bottom of the range that we've occupied since late last year. We can see that after rapid disinflation from 10.6 down to about where we are now over the course of the second half of 2022 and through 2023, we've now sort of anchored at these levels. And if we look at the component contributions to CPI here, we can see that the main influences of pandemic era shocks and war shock with the onset of the conflict in Ukraine, we've seemingly digested the spike in food. That's down to more reasonable levels. We've seemingly digested the spike in energy. And although energy is rising a bit as a contributor from May to April here, it is nevertheless relatively constrained. You can see that here. Of course, energy was a big source of shock here as the war broke out. It then rebalanced and rebased here and is now this little sliver in the mix. So not a huge contributor. Rather, this seems to be the biggest sticking point. And of course, to the extent that the hospitality sector, restaurants and hotels, amounts to discretionary spending, an economic slowdown ought to make this stickiness in the price structure more amenable to disinflation as people scale back amidst whatever economic weakness is ahead on the kind of discretionary spending that powers restaurant and hotel pricing power. And as we get deeper into the summer and closer toward the end of that season, seems likely that this is going to unravel and inflation is likely to march more convincingly toward the ECB's objective. The bond markets are already onto this, seemingly. The German 2-year break-even rate, this is the difference between nominal and inflation-adjusted interest rates over the near term in what is, of course, the Eurozone's largest economy, and extracts out of the bond market's pricing that inflation adjustment, the implied inflation forecast that the bond markets have for Germany over a 2-year window. That has been falling precipitously here in recent months. We can see that here. So much so that we are actually now at 1.29%, which is well below the ECB's target. While, of course, this doesn't line up one for one, it does suggest that inflation expectations have been falling and the ECB appears to be on track to where it wants to go. Now, of course, what's interesting in this context is, again, that the curve doesn't seem to have changed in a meaningful way from June to now, despite the fact that we've had this downshift in the economy, which seems to suggest that there is room here for the ECB to surprise markets somewhat with a dovish pivot in official rhetoric. So as we get to this policy announcement, let's assume that there is no surprise change in rates. There is, after all, that slight possibility. And if we were to get that kind of a thing, we would likely see a very emphatic response from financial markets. But even if we get everything on the policy outcome exactly as expected, the rhetoric from ECB President Christine Lagarde and the tone of the policy statement coming out of the Governing Council may well take a more dovish tone, onboarding and flagging the economic data that has arrived between the meeting in June and now, and give a nod to the idea that disinflation appears likely to continue, that economic weakness has become seemingly more of a concern. What this might do is inspire a bit more of a concrete push to 50 basis points here, cementing these two rate cuts, and perhaps even extend to a more significant amount of easing. It might also upshift the timeline. So September might get locked in. A second cut could well be locked in as soon as October, giving room for some optionality on a third cut in December. Now, what's interesting about this may well be the direction in which an adjustment like that would push financial markets. So let's first consider the euro. This is a chart of Euro FX futures, ticker 6E. And what we see here is the euro finds itself attempting to break this range that it's been stuck in basically since mid-April, extending here past the 109 figure and attempting to take out these tops just below 110. Now, if we get a dovish ECB that sets the course for deeper interest rate cuts down the road, that may well arrest the euro's upward progress here, maybe set up another top in the vicinity of this one and this one, somewhere in here, and set the stage for the US dollar to begin a recovery. Because, of course, if the outlook on Fed monetary policy has been pretty well locked in over recent weeks, and of course, we know that there's been a dovish shift there recently, which might explain what's going on here. But to the extent that we're out of major U.S. economic data, at least for this week, and we now have that part of the story relatively locked in against a backdrop of a would-be dovish adjustment from the euro side, we might expect that if the ECB does in fact go that way, that we'd have a top, at least near term, and perhaps scope to oscillate down into the bottom of this range over the coming days and week. But the much more interesting part of this story, the one that's perhaps somewhat counterintuitive, is what may happen to local stock markets. This is where things get really interesting. This is the EZU ETF. It is a tracker of the MSCI Eurozone stock index, also very close to the Euro Stocks 50 index, the Eurozone stock benchmark. What we see here is this right here, this top in the index is exactly June 6th, the day that the ECB starts to cut interest rates. The first cut in this cycle. Now, what this speaks to is perhaps the very same dynamic now getting ready to reveal itself, if it has not already, in U.S. markets. Stock markets, of course, we can see here, have been perfectly happy to speculate on the prospect of rate cuts, especially while economic growth is improving. Cheaper credit without an economic downturn is understandably good news for risk-taking and so for stock markets. And of course, as we've just mentioned, the growth story in the Eurozone since the beginning of the year has been of improvement. There it is. Meanwhile, the story on monetary policy since the beginning of the year has been of rate cuts. Now, of course, since the growth story has been improving, the scope for these rate cuts narrowed somewhat. And this was the cut itself, so we'll take this part of the chart in isolation. But the run-up into the cut, which is this to here, had improving Eurozone data, improving Eurozone growth. So not surprisingly, we went from 160 basis points in cuts to 67 basis points on the eve of the reduction, which is this wiggle right here. But nevertheless, rate cuts. And so the prospect of lower rates against the backdrop of growth that was improving not surprisingly, a very positive catalyst. When those cuts actually arrived, however, what that seemed to signal to the markets is as speculation becomes reality, it becomes time to worry about why the central bank has finally started to pull the trigger. And that is, of course, because it has found whatever is happening economically to be intolerable enough that it felt compelled to act. And so while the markets were perfectly happy to speculate on some future date for the start of rate cuts given benign growth, once the central bank actually decided to move on those cuts, despite the fact that the move was widely priced in and expected, the implication became, well, now we need to be worried about the growth side of the ledger and where earnings come from. Because if the central bank has felt itself compelled to cut, it is not for no reason. This, of course, echoes with some delay the story that we're seeing developing in the US, where a rate cut in September, the meeting after this upcoming one at the end of July, looks overwhelmingly baked in. The scope for interest rate cuts has grown. And yet we find ourselves with the kind of dramatic sell-off that we now see in markets for seemingly incongruous reasons, which may well begin the kind of topping process that we see here and around the same logic. That when the cuts do finally arrive, the concern is about growth rather than a positive response to the final arrival of cheaper money. And so near term, what we find is that if the ECB is going to take a dovish tack, yes, it probably means the euro has some scope to backpedal on some of these recent gains. It may also extend lower on Eurozone stock markets. The lesson to be had if such a move does materialize on a dovish ECB is that US markets may well follow the same dynamic. And if the moves we saw today continue to extrapolate, may be following that dynamic already. Though, of course, follow through is necessary, and we've yet to see that. So, if anything, it could be early days yet for Wall Street. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean going forward. I'll be on in just 30 minutes after this show for The Price of Truth, the great new show with Victor Jones. Back on with Chris for Futures Power Hour Friday. On with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Happy trading.